A lot of people who think about wanting to build passive income or think about financial independence, retire early, which is fire. They think about investing in income from day dot. But the way that I think about it is more of a two-step process. Have the goal and the dream of living off your investments and generating passive income and telling your boss to go and get stuffed. But that doesn't mean buying assets that pay income from day one. It's a two-step process. The first one is building that portfolio to the point that you need it, generating enough capital growth to then go to step two, which is optimized for income and invest in those income producing assets. Thinking about it as a two-step process will get you there faster because that step one will get your portfolio to the size that you need it faster. And then you can generate income off a larger portfolio. So with that caveat in mind, let's jump into how anyone can start dividend investing.
So as you said earlier, Ren, everyone I think who has a core portfolio is index investing. And I want to put some numbers to that to illustrate your point. The ASX 200 has a distribution of 3.5% a year.
Yeah.
So it's not wild. It's not, the double digits that some products spit out. But the key thing here is you are getting a dividend. Through index investing.
It's not wild, but like if you can get your superannuation to $1 million by the time you retire, 3.5% yield is $35,000 a year.
Well, the leveraged ETFs that I have in the portfolio, for example, GJUS, it's 4.67%.
Yeah.
So still not wild.
People aren't.
But that's US.
People
that's US.
Yeah. So I
guess my point was, if you think you're not dividend investing, you probably are receiving some dividends to start with.
Okay, so what should everyone who's receiving dividends? How should they approach their dividends?
I think if you're not doing it for passive income and you don't need the cash, you should be reinvesting those dividends as fast as possible. And either doing that by a dividend reinvesting program, which you can set up through the same stocks, or actively ensuring that if you get it paid in cash, you're putting it back in the market in another opportunity.
Yeah.
I think having them just sit in a bank account or take them to the pub or whatever is the worst thing that you can be doing. You want to be reinvesting those as fast as possible.
Definitely. So you've kind of answered it. So let's just explicitly answer it here. The one question we got was, can ETFs pay dividends? And as you've just explained with some of those examples, yes.
Yes.
Now, a terminology point of view, we're talking about dividends. And if a company pays you a share of their profits, you'll see it called dividends. When an ETF pays their equivalent of a dividend, you'll often see it called distribution. For our purposes today, dividend distribution means the same thing, cash in your pocket.
So that's the ETF side of things, and we'll get to a couple of our favourites in a moment. But of course, here in Australia, there are stocks that pride themselves on paying healthy, continuous dividends, and you can build portfolios with individual stocks that are known to be long-term dividend-producing companies that don't necessarily have that long-term capital growth that you're looking for, but have consistently paid good dividends. We've actually done a number of segments on the shows. What are they called? Dividend aristocrats?
No, they're in the US.
They're the US ones,
yeah.
But here in Australia, I think there's 25 odd companies or so that have consistently paid dividends for the last 30 years or so and haven't reduced them.
I'm sure. Yes. I'm sure there are. Washington Soul Patts, which I think is now just Soul Patts, is famous for just continually increasing its dividends. The banks have cut dividends at different times, but they've just been consistent dividend payers. But who you were referring to, Bryce, is the dividend aristocrats, which over in the US are companies in the S&P 500 that have raised their dividends for at least 25 years. And there's 100 companies in the dividend aristocrats. But there are some companies that have been doing it so long that there are now dividend kings.
Oh, wow.
Yeah, which I believe are stocks that have raised their dividends for 50 consecutive years.
Wow.
Yeah. So if you're interested in consistent dividend paying stocks, have a look at the dividend aristocrats and the dividend kings over in the US. The important thing to note is that whilst they continue to increase their dividend yields are still lower than their Aussie peers for all the reasons we spoke about earlier.
Yeah. Now, we'll put a link in the show notes to the Morningstar page that has a list of all the Australian companies and what dividends they're paying. Also, the upcoming dividends that they've announced. For example, Rio Tinto is the leader here in Australia, having announced $3.50 per share.
All right, well, let's close this episode out by talking about some ASX dividend ETFs, some that are specifically designed to generate you income. And I think a really important thing to note here when we're talking about stocks, when we're talking about ETFs and their yields, they're trailing 12-month yields. Now, what do we mean by that? With the way that it's calculated is you look at the dividend or distribution paid over the last 12 months and then divide it by the current share price. So often, if a stock has tanked, their dividend yield will look really juicy because you look at the last 12 months of dividends and then you compare it to today's share price, which is in the toilet. And so that's called a dividend trap. And so you've always got to be a little bit mindful about just looking at dividend yield and investing in those with the highest yields because it is backwards looking, not forwards looking. But with that said, let's have a look at some of the ETFs that are specifically designed to pay income.
Nice. So the number one in Australia at the moment is the Switzer Dividend Growth ETF. The ticker is SWTZ, an active portfolio looking for long-term growth, but also, as Ren said, specifically built with companies that pay dividends. So they'll actively manage that to ensure they're not falling into this dividend trap and they're long-term sustainable dividend payers. It did have a yield of 11.23%. Then there's the BetaShares Australia Top 20 Equity Yield Maximizer Fund. YMAX is the ticker there, 7.5% yield, again set up specifically with companies that pay dividends. Morningstar Australia Moat Income ETF DVDY, 3.3% yield. The Australian Select High Dividend Yield Fund SYI, 4.84% yield. Then there's the Vanguard Australian Shares High Yield ETF, ticker is VHY, a yield of 5%. We did an ETF Explained episode on that. We'll include a link in the show notes if you want to go deep. But I think my takeaway here, Ren, is the yields fall pretty quickly back to what I would consider just your standard boilerplate ASX 200 yield. That, I mean, they're a little bit higher, but if you just invested in the index, you're going to get very close to what these specific funds are spitting out.
Yeah, it's almost like every episode that we do of the podcast goes back to just buy the index.
I know.
But it's because the index is a powerful and elegant thing.